Hi, everybody. I'm Mark Osterkamp, Head of Client Partnerships at IMC. Welcome to Inside Inform Momentum for the fourth quarter of 2025, where we share observations and insights on global equity markets. Today, I'm joined by Travis Prentice, CIO at IMC. And Travis, let's start with the rally that began in early April. What worked? What didn't?
Wow, well, there's a lot there. There's a lot there to unpack. But yeah, one of the most hated rallies probably of all time, precisely because what has led the rally, which has tended to been more low quality characteristics, but the best performing characteristic was high beta. So definitely a risk on rally that left many active managers behind. In fact, in small cap, since the rally, the 6-month rally since April, has been one of the worst periods on record for active management, where the median manager is something like 800 basis points behind over that 6-month span. So a very difficult market to keep up with.
I think you're going to know the next question I want to ask, and since every single client we've met with recently has asked this, low quality did well, momentum did well. Did momentum just load up on junk?
The short answer is no, but it depends on the implementation of momentum. But what we've seen is obviously the market in general has been driven by lower quality characteristics. However, there's a big differentiation I would put forth between improving businesses and kind of backward looking or high profitability. So I think we've done well in this environment precisely because we're looking at not only prices that are improving, but also businesses that are improving. And that's a big point of differentiation, whereas maybe a naive momentum strategy that just purely chasing price might be really susceptible to when this reverses. I think if you're looking at momentum more holistically like we do with Inform Momentum, which is the confluence of, yes, prices that are doing well, but businesses that are improving. So it's really about the improvement of profitability rather than kind of the absolute looking backward measurement of profitability or quality.
Yeah, and hey, and speaking of quality, I think it's probably a good time to revisit a paper we wrote middle of last year called Momentum and Quality. Um, you know, it's clearly relevant right now. Can you share some takeaways from that paper? That'll be helpful.
Sure, yeah, we're big believers, according to our research, of the premium associated with both quality and value. So we would be strong advocates of not abandoning those two disciplines because we think there is excess return with those factors and the factor premium associated with those. However, we have noticed that most investors tend to be quality and value biased within their kind of portfolio allocation. And certainly we believe that adding momentum to that mix balances risk better, which is more aligned with more optimal performance over time. So we would say don't abandon quality and value. And if anything, they're probably positioned to kind of do a little bit better going forward because of the significant underperformance recently. But we always believe in mixing the factors of momentum, quality, and value to get more optimal outcomes.
All right, so balancing risk, basically.
Yes, and yeah, that's our tagline, balancing risk with informed momentum. And it's not just, I mean, the good news is not just us saying that, it's actually backed up by empirical data. And that's what that momentum and quality piece did so well, I think, is just lay out, how to improve outcomes. And certainly adding momentum to a portfolio will help you do that.
Yeah. So the big question, where are you seeing momentum now?
Yeah, and momentum's an adaptable thing, right? It's a chameleon, so it's always moving towards strength and away from weakness. And I think there are some new trends that have emanated very recently. I guess the biggest, and this is kind of globally, but maybe more so in the US, but pharmaceuticals. So big pharma has done very well, very new trend, very strong momentum. Biotech within the US, after kind of 10 years of not performing well, we're seeing a very strong new trend within biotech. And that's more of a US phenomenon, where in the non-US it's more pharma related. So globally we're seeing kind of resurgence in healthcare in general. On top of that, I think there's been a continuation of momentum within European banks obviously in the non-US marketplace. That's continued. Metals and mining, that's in the US, but a little bit more in non-US, so Canada's done very well on the back of that performance. And I think lastly, what we're seeing right now is a little bit of a resurgence and some idiosyncratic opportunities within consumer discretionary. So we're seeing some new areas of momentum kind of outside of tech and AI industrials, although those continue to do pretty well, even given kind of the speed wobble we saw kind of in the last couple of weeks. Those companies are still trending very well, but it is nice to see some momentum and trend kind of outside that one area.
Yeah, it sounds like it's broadening out a bit.
Yeah, I think that's fair to say.
Okay.
And for us, it's great, to be able to go where the strength is and away from weakness. And a great example of that is, we've talked about European aerospace and defense being a big trend that we kind of captured kind of the back half of last year and for the balance of the first part of this year. But we're seeing momentum move away from that. And so it's being replaced by some of these new trends that I mentioned.
Great. Well, appreciate the time today, Travis. Again, thank you very much for joining us and this edition of Inside and For Momentum.
Thank you.